Hey everyone, welcome back for part 4 of me revealing my entire stock portfolio. Now, if you haven't gotten the chance to watch part 1, 2, and 3, I definitely recommend at least skimming through it just to make this tie together a lot more nicely. And if you like this type of content, please consider subscribing to the channel. I'd appreciate it a lot. So, I've gone through this slide over the last couple videos as well, but this is just a summary of my portfolio to date that I've gone through. And then just a bit of background. You can pause the screen if you want to learn more. But this is an entire equity portfolio. I hold ETFs separately, not on this list. And I'm primarily a dividend investor by both Canadian and US equities. And you'll see that come to life in what I've shared so far, but also what we'll be talking today as well. So without further ado, let's jump into it. Stock number 11 I hold at about 3% of my portfolio is Rogers Communication, which is a very large telecom company in Canada. So Rogers stock has kind of been a bit all over the place lately. One thing that's really moving the stock has been a pending transaction they've had with another communication company in Canada called Shaw. So the market really wants this deal to happen. The stock was really trending downwards behind low likelihood of it occurring and has really rallied hard the last few months of the year behind some positive court approvals and such. So the company's actually up 4% over the last year, which is very good performance given the type of company and the amount of debt telco companies have right now in an environment with increasing interest rates. So companies performed well overall. They pay about a 3% dividend, and they're trading. I believe this PE is a bit higher than reality. I believe their free cash flow is about 15, 16 times, and their PE is in the high teens right now, which is still higher than it's historically been for this company, as the market's really projecting that Shaw acquisition and for synergies to be derived from that. But nonetheless, a relatively safe company to own over the long term, pretty stable in the markets they play in. Going into the company a bit more, the main thing that Rogers is known for in Canada is their wireless business. This is from their 2021 annual report, since they haven't done their full year 2022 report yet. But you can kind of get a sense, 60% of revenues coming from wireless, but 70% of the profits coming from wireless. So phone plans and such are the biggest part of their business. Cable's the second biggest part of their business. A bit less excited about their cable exposure, but in Canada, the cord cutting has seemed to be a lot of a slower headwind than some of the telcos in the US. So that's still been a business that's been holding flat for them over the last number of years. Media, if you don't know, Rogers owns 100% of the Toronto Blue Jays, which is their biggest media asset. And you'll see some of the other media assets they hold on the next few slides. But this is a bit of a misleading EBITDA number because it was some front half COVID dynamics in 2021. So their media business in recent quarters are back to profitability, still significantly lower than wireless or cable, but it's not a loss business by any means. Just to go into the wireless piece of the business, very high wireless margins, primarily service revenue. They have a portfolio of brands across Canada other than their flagship brand under Rogers. They also own Fido and a couple others. And they have over 10 million mobile wireless subscribers. So about a third of the country, about 30% of the country, let's call it, has a phone plan where they're paying wireless recurring revenue on a monthly basis, which is really the main reason to own the stock. In terms of their media assets, so they do own exclusive rights to the NHL for about 3 more years, I believe, in Canada. I think that the rights to acquire this have been very expensive, and I'm not sure it's entirely paid out yet. So that's something that, as those NHL rights come up again, it'll be interesting to see if they bid, how heavily they bid. I know Bell, who's another very large cable provider in Canada, the leader in Canada, will probably be bidding against them again. So we'll see where that nets out. But for the time being, they own the NHL exclusive national rights. Oh, until 2026, so I was a couple years off. The other assets they own, I mentioned Toronto Blue Jays, but on top of Toronto Blue Jays, they also own about 40% of Maple Leaf Sports Entertainment, which includes teams like the Toronto Maple Leafs, the Toronto Raptors, Toronto Football Club. So them, Bell, and then a third party kind of split that business almost three ways. Bell and Rogers own a bit more than a third. So they're deriving a lot of synergies in terms of their cable and their sports broadcasting access from their ownership in those companies on top of the Toronto Blue Jays. So they do have a nice presence in sports, but it's definitely a minority of the overall company. And then just in terms of their performance, they do about, let's call it $2 billion of free cash flow, and the company's trading at about $33 billion market cap, I believe. So they're trading 16-ish, 16, 17 times cash flow. So yeah, a bit higher than historical and then you'd like to see on a telecom company. But they've been really stable and slowly growing over the last decade. So they've kind of deserved a safe multiple. They also experienced, I believe they beat lots of their guidance for 2022. So this was 21 where they had some issues in the front half, especially on their media department. But in 2022, I believe they actually did better than ingoing guidance. So these numbers are a bit understated likely versus what they'll report in the coming weeks. So for Rogers, you're getting a pretty safe business, primarily buying a wireless service provider, the largest one in Canada. You're getting 5 to 6% returns on your money, half of it being paid out in dividend. Historically, the other half going to different sorts of investments, building out their network in addition to buying back shares. That's kind of hauled over the last couple of years as they've been just saving money for the Shaw acquisition that they think will go through in the front half of 2023. But overall, I think safe company, returns capital to shareholders, very safe dividend. They increase it over time. And that's why it's a decent sized position in my portfolio. Going on to stock number 10, First Capital Realty. So First Capital Realty is another real estate investment trust in Canada. And they focus specifically on the retail market in Canada. They do have some exposure to residential, some exposure to office, but similar to in a prior video, how I was saying Allied is primarily office with little bits of parking and retail. First Capital is really primarily retail with little spots of office and residential. So you're buying a retail REIT here. In terms of their performance, this company has performed pretty well over the last couple months, up about 20% from $15 mark. And there's a lot of drama going on in the background with this company. They have a lot of activist investors who think the company is being mismanaged. I believe their net asset value, if you take the value of their assets that get re-established every quarter and you take down the debt, is about $25 a share. So you're getting about almost 30% off the actual value of the real estate the company holds at these values. That was closer to 40% off a couple months ago. So they're doing things like selling off parcels of land and real estate assets that aren't generating a lot of cash. They're taking that money and they've started to buy back shares. Some investors don't want them to do that, and they've kind of made a case for why the company is not being adequately managed and so on and so forth. So it's a bit of a fight inside the company currently. But overall, at the end of the day, they're paying me almost a 5% dividend. The value of the real estate the company holds is significantly below the value of the stock that I'm buying. And they own very strong assets across Canada. Just going through their geographical mix a bit, you can kind of see half of their business is in the GTA. Lots of this is downtown Toronto, Yorkville, and some very high-profile intersections in Toronto, some of the best retail real estate in the country. And then they kind of split off on other major cities. First Capital really focuses on being present in communities with very high incomes. They're very prominent in the most luxurious neighborhoods in the country, and that's where you'll find lots of their real estate. They scorecard themselves on household income within X kilometers or X miles from their properties, and they have the highest ranking in Canada on that metric. So they really are focused on positioning themselves in good spots and spots where there's a lot of high income people doing a lot of shopping, buying a lot of goods. And the other good thing about First Capital is they have about 70% of their um, 70% of their rents coming from pretty much essential services. So you can kind of see here, almost 20% of the rent is like basic necessities, Walmart, Dollarama. Another 17 is grocery stores. So 35% is just essential needs in grocery stores off the bat. Medical professional services, 15%. Fast food chains, 13%. Pharmacies, once again, just like retail stores and stuff like that, 10%. So yeah, very safe business from that front. Lots of these stores, even in a recession, still need space. They are completely reliant on a retail presence. As you go down to some of the less prominent tenants of theirs, they have some fitness exposure, 3%. Banks and credit unions that may shrink their retail presence over time, going more digital or during a recession at 8%. So they're definitely not immune, especially as we look at other tenants like Nordstrom, Sleep Country, Indigo. They're definitely not immune to an economic downside, but they have enough strength at the top of their rent list here that they'll definitely be able to get through it. And then this is just to highlight the type of assets this company owns. For people who may not live in Toronto or Canada, you may not fully appreciate some of these images, but these are assets on some of the most expensive neighborhoods in North America, not just Canada. In Yorkville and Toronto, Liberty Village, some very prime real estate worth hundreds of millions of dollars, and just the type of real estate that even as retail space becomes maybe less needed as a whole, as a macro trend, these are the type of spaces that, if anything, are just becoming more popular as the economy and the geography densifies around major cities and in these popular areas. So their assets are very well positioned. They only own about 150 assets, which isn't a lot given the size of their market cap and net asset value. But it's just because the assets they do hold, lots of them are worth significant amounts of money and just hero flagship assets. So I really like their assets, love their portfolio, think the stock is trading significantly cheaper than I'd be able to buy this real estate for on an open market or anything. And I'm getting a monthly dividend, 5% annually, essentially, to hold and see that value get created, whether it's through share buybacks or other activist activities that I'm not going to get into. In terms of the valuation, they had some issues at the first half of 22 on a funds from operations standpoint. So this is even understated versus forward looking. They're pretty consistently growing 15-20% funds from operations now, but they're likely going to do about $1.10 this year in 2022 and probably closer to $1.25 next year. So the stock's trading, let's call it 13-14x funds from operation. So on top of that 5% dividend, they still have a bit more money left to invest in other opportunities, or knowing what their focus is, probably will buy back shares. So the company, I think at 12, 13, 14, for the quality of these assets, you'll never be able to buy one of these assets trading at like a 7% cap rate or something. So I think it's a good investment where it is today. Obviously not a massive part of my portfolio, but it's a relevant part. So I do like this stock, and I know it's gone up 20%, so not adding to it currently, but it's one that I'll keep an eye on throughout the year. Going into stock number 9, CIBC Bank has a very similar investment thesis for me as Scotiabank. I just think lots of these banks, especially the smaller ones in the big 5 banks in Canada, have just gotten so cheap, way too cheap, given their relatively limited risk profile in developed markets and countries that don't really go into extremely deep recessions, don't have extreme currency risk or anything like that. Stock right now is trading 8 times earnings, 6% dividend yield. It's just very surprising how cheap these stocks are trading, given that they've been growing over the last few years. They have a forecast for growth for this year, and they're just trading at 8 times. So I'll take that in my portfolio every day. I'm looking at adding to banks throughout the year. I think the sector has overcorrected, to be honest, even given the macroeconomic climate. I think they're positioned maybe not fantastic, but definitely better than what they're getting priced in for. Going through some of their revenue mix, on Scotiabank, we called out how they had a really big South American business that was dragging down their performance and return on equity. Return on equity at CIBC is a bit lower than some of their peers, 14%. Still not bad, but they really have a very big Canadian business. So they don't really have a big play outside of Canada yet. 36% is personal banking, 30% commercial banking. So that's 2/3 of the company right there, just Canadian banking. They've made a couple tuck-in acquisitions in the US for wealth management, about 10% of the business. And I was actually surprised to see that 30% of their business is capital markets. But I guess that's where they may have some exposure to a business that can be very volatile to the downside during a market slowdown. But overall, even if this was wiped out and this went to zero, it's still 10 times earnings. I don't get the valuations here, so I'm going to keep averaging in and buying into my favorite banks. Remember, the stock was trading for under 60 a share. You can see EPS over the last number of years, $6, 2020 was a tough year for a lot of reasons, obviously, up to $7 and then $7 again. If you look over 20, 30 years, you'll see a nice glide path over time. So it's been a bit choppy, but at the end of the day, over $7 in EPS for a stock that's trading under $60, I'll take that return on investment as they give it to me through dividends and buybacks. And then just on the topic of capital allocation, so they're investing more in organic growth. This is very similar to all of the banks, by the way. They have very similar capital strategies. So organic growth, paying about half of their earnings through a dividend. So I'm getting a 6% dividend. It's a great return on my capital. And then I'm getting another 6% working for me inside the company through buybacks, as well as other growth investments to drive organic growth. So I like that model at these valuations. In organic growth, they've been making some acquisitions. They're really trying to break into the US, but they're being pretty careful with it. So they're making smaller wealth management acquisitions. I'm supportive of that. I think the US is obviously where more growth is for these Canadian banks since they're so developed in Canada. But honestly, at current valuations, I don't mind buying back shares instead of making a big splash in an acquisition. So I think buybacks and driving organic growth are probably where I prioritize investment in 23, unless the stock price considerably goes up. Okay. Oh, one more slide, I guess. Dividend history. So you kind of got a bit of a choppy picture over the last few years on the EPS, but this company's consistently increased their dividend over the last 15 years. Average dividend increase of 5% over 15 years, but you can see it's over doubled over that time period, which is phenomenal growth. So yeah, I don't know. Someone let me know if they have a different outlook for just banks in general, but these banks trading 8.5 times, the 30, 40-year track record for sustained growth, in completely exposed to developed markets, increasing their dividend for decades on end, seems like a no-brainer to me. And I think it's an area that I should probably be investing more in. One last slide. I keep forgetting I have more slides. But one thing in terms of their risk profile, one of the reasons they do get a bit of a cheaper valuation is their exposure to the Canadian real estate sector. But they have very good loan-to-value ratios. It's been going down. They've been deleveraging in terms of how much loan-to-value they're taking, or they're just continue to glide path towards a lower number. So we're seeing these 45 to 50 loan to value, which is, um, you know, not bad. You'd have to see over a 50% correction in real estate for them to really have any exposure. Could it happen? Sure. But I think the risk reward, given the valuation of the company, is pretty strong. Stock number 8, Microsoft. So Microsoft is one of my favorite stocks that I have bought over time, and I've actually never jumped into Microsoft in a very big way, just because the valuation's always been expensive. It reminds me a bit of my feelings on Visa, where I love the business, great management team, great growth prospects, but it's just tough buying businesses for 30 times earnings when you can buy like a REIT or a royalty fund and get 6-7% back annually over that time. But I have been trying to buy dividend growth stocks as well. And Microsoft's one that just over the years, I've built it into at least a meaningful position here at 3.6% of my overall portfolio. You can kind of see here the stock's valuation has dipped a bit. So it's trading at about 25 times. Microsoft will probably do about $10 of earnings this year, give or take. So probably 23 to 24 times forward earnings. But this stock historically has traded 30 to the low 30s in value. So they've also been hit on a valuation with the dividend changes, not the dividend changes, sorry, the interest rate changes that we've seen here in the last year. But I think it's a great buying opportunity. The company continues to pump out lots of cash. For those of you who don't know Microsoft in depth, they obviously own the Microsoft Suite, like Word, PowerPoint, etc. But one of their biggest businesses and profit drivers is Azure Cloud, which is a great business. And on top of that, they also have investments like owning LinkedIn, that's starting to become very profitable and growing fastly for them, as well as a gaming business backed by Xbox. And they currently have an acquisition that they're trying to close on as well that we'll talk about quickly. In terms of their overall performance, despite a tougher economic climate, they continue to grow double digits, $50 billion in revenue in the quarter. Look at their margin structure. 70% gross margins pretty much, and then 43% operating margins. Net income, $18 billion on a $50 billion revenue number. So they have net income margins of 35%. Really, really strong financials on the company, and they continue to fuel it and scale it and expand margin over time, despite that, with good revenue growth and lots of good trends on their business for the future. Last thing, I'll just touch on Microsoft because I'll probably do a longer video on Microsoft one of these days. But they're in the midst of buying Activision Blizzard for, I believe, 60 to $70 billion somewhere to really accelerate the growth in gaming. So Microsoft is one of the big tech companies who's actually been able to get away with a lot of acquisitions over the last number of years. This would definitely be the biggest one. They are receiving some pushback, but analysts and experts think that they'll actually win out and be able to acquire Activision Blizzard, given how segmented the gaming space is today and their plans for how they're going to utilize the asset once they get it, in terms of not going exclusive with Xbox and stuff like that. So I think this would be great for investors as another lever of growth. At some point, they'll probably get more and more scrutiny around acquisitions. So build the business and build these brands into the business while you have the opportunity. You can always buy back shares later with your capital as an option, but you may not always be able to acquire a really strong asset that's going to change the game on one of the segments that you're bullish on into the future. So I think this would be a great buy if it closes. At the end of the day, the value of Activision Blizzard's like 3% of Microsoft. So this isn't going to swing the business one way or another. It's not my reason for buying or not buying the stock, but a nice soundbite in terms of areas they're looking to grow the company organically and inorganically, in addition to driving EPS through operating leverage and share buybacks. All right, going into the last stock for today. Disney is a stock I can say a lot about. I actually am planning on making a separate video on Disney's board and Nelson Peltz and everything that's going on there. But Disney has been going through a lot over the last few years, and it's one of the stocks that I own that I feel like is having a bit of an identity crisis which is pretty unconventional if you look throughout my portfolio. The vast majority of these names are just boring companies that consistently pay out dividends on very consistent earnings, with the exception of a couple names. But Disney is definitely one that is still trying to figure out how they're pivoting into the new era of media. But my hypothesis on Disney is, if any conventional media company is going to make it, which they will, and figure out the economics over time, I think Disney is the best one, has the best brands, has the best assets, is the stickiest with families and children. So I know it's kind of expensive and tough to pivot, and it's painful going through it as a shareholder, but I'm confident long term, hopefully medium term, that this company will be one of the ones that comes out on the other side and is a winner in this game. Now, some of these numbers are a bit hard to look at, but I just want to focus on a couple things here. So, operating income by segment, you can kind of see their operating income on their media division, because of the streaming, has been essentially wiped out to flat, despite having over $12 billion in revenue. So this is obviously painful to go through, painful to watch, but it's just part of the process of them shifting into streaming. And we'll see how that develops over the next year. I really want them to either cut spending or figure out a way to increase prices to make streaming not as dilutive to the overall business. Even if it's not making money, you can't have half of your business's cash cows and profit stream being offset by that initiative for years and years. If it's 1 year, fine, but we're on like year 3 now. So they have to figure out how to stop that from being such a suck on their business. Their parks has been doing very well. $8 billion in parks experiences and products operating income in last fiscal year. There's some sentiment that they're over earning in the parks. They're charging people too much. It's not sustainable. People are going to backlash. I don't have a strong opinion on that. I understand both sides of the coin there. From me sitting in my seat, given what's happening on the streaming side, I'm not in a position to complain on over earning in the parks today. But yeah, maybe if that's a existential risk to the equity of the parks and people not wanting to go because it's too expensive, hopefully that's something that gets right-sized once the right economics and the right decisions are made on the media side of the business. Cash flow, another painful one to look at. This is like $180 billion company at today's valuations. So obviously doing $1 billion in cash flow last year, driven by significant investments in streaming and media, is terrible and not a sustainable multiple long term, paying 150 times cash flow. But I really think that this company could do $15 billion in cash flow in the medium term once they get streaming figured out. They have the cash flow from the park flowing straight to the bottom line. Cable will still be providing money, ESPN for the medium term, and then streaming, hopefully once they get up to Netflix's scale and pricing, can also provide cash flow. And when you add it all together, I think the company could be trading today at 10 times cash flow in future years. So ugly picture now. The stock price is paying for it, but I really have a very long-term horizon on my Disney investment, and it's one of the few, I'd even call it speculative bets, given the nature of their income statement today. Lastly, just to check on their subscribers, they're investing huge here. So yeah, they're getting lots of growth, 164 million Disney Plus subscribers. 60 of them are Hotstar, which pay like $1 a month, but still over 100 million Disney Plus conventional subscribers. Pretty good development and scale there. But, they're paying tens of billions of dollars in content, exclusive content, to get here. So it's good numbers, but they're buying it. And it's not sustainable what they're paying to achieve these customers from a customer acquisition cost. ESPN Plus continues to impress. So I think they're going to blow their initial estimate out of the water in terms of their streaming estimates for ESPN Plus by 2025. I think they're getting there now. But at the end of the day, this is more of a nice to have, part of the whole bundle and building out how ESPN plays and being a major impact on the overall company. Hulu's an interesting one. Will be very interesting to see what they do with Hulu over the next couple years. Do they buy the third from Comcast that Comcast owns to own it outright? Do they sell outright to Comcast and let Comcast have that as their streaming play? I'll be watching very closely. I think that's probably one of the biggest decisions for Disney to make over the next 24 months. Okay, so that is all of my stocks for today. What's interesting is we've gone through 22 of my 28 stocks, and I believe from a portfolio value, we've just gone through 50%. So my portfolio is very top heavy. My top 6 positions are the other 50% of my portfolio. So really looking forward to sharing those positions with you and companies that I'm very bullish on. Have a lot of comfort in holding a large part of my portfolio in, and I'll do that in the next part of this video. But if you like this video, you own any of these stocks, please let me know in the comments. Also, would really appreciate it if you subscribe to the channel. We've got up to 20 subscribers, which is awesome. Thanks everyone who's subscribed. But if you haven't yet, please hit that subscribe button in the bottom corner, and I'll see you in the next one.